Studies have shown that maintaining a well-diversified portfolio of 25 to 30 stocks yields the most cost-effective level of risk reduction. So, the studies do not show greater returns when we diversify, but lower risk. So, logically thinking, if we want to have higher returns, then we should have more concentrated portfolio. But the first rule of investing is never lose money. And if we diversify our portfolio, we have a bigger chance of not losing money. So maybe diversification should be the way to go. Maybe it is more important to lower risk than to have big returns. Let's try to find out what is the best strategy. And I think the smartest way to find an answer is to ask some of the best investors in the world. And I want to start with Ray Dalio, who is an American billionaire investor and hedge fund manager who has served as co-chief investment officer of the world's largest hedge fund, Bridgewater Associates.
I'm big on diversification.
You're very big on
It's
diversification.
Like, knowing how to diversify well is more important than almost anything. Through diversification, I can improve my return to risk ratio by a factor of 5. So by diversifying, okay, the return relative to the risk, I can keep my returns the same and reduce my risk to 1/5 if I know how to diversify well. And that's why I'm explaining it. It's not all that complicated. It's simply explained in the book. Let me take all those investments that I think will make 10%, so that's my return, but they're uncorrelated with each other. That means I'll still get the 10. I don't lower my 10, but my diversification means I lower my risk. So I improve my return to risk ratio.
So Ray Dalio is a big fan of diversification, of owning different kinds of assets and not correlated stocks in different countries and different markets. He believes that by doing that well, we can have great returns while at the same time lowering our risk of losing a substantial portion of our money. So now let's see what Warren Buffett thinks about diversification.
We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood. And to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness.
This is a completely different approach to what Ray Dalio believes. If you don't want to learn about stocks and invest, you should diversify as much as you can. And you do it through index funds, where you own hundreds of different companies. But if you want to learn the game of investing, then you should find only the best businesses. And if you find 3 great businesses and bet big on them, you will do exceptionally well. We have 2 opposing views. So now let's hear Bill Ackman, another American billionaire investor and hedge fund manager. But his investment approach makes him an activist investor.
I mean, I've always had the view that why not own the best 10 or 11 investments as opposed to ideas 12 through 25 or 12 through 100, which is more typical. And I think there are very few great investments at any one time. So the ability to concentrate is an enormously valuable asset of a strategy. The problem with it is it leads to bumpier returns. But if you want to make high rates of return over a long period of time, it's hard to do that being very diversified. I mean, if you look through the Forbes 400, wealthiest people in the world, Most of them made their fortune in one business.
So, Bill Ackman is a big believer in concentrated portfolio. He talks about investing in around 10 of your best ideas and forgetting about all the others that seem not as lucrative. And he is not alone in this view. Let's listen to Mohnish Pabrai.
If you look at most entrepreneurs, they don't even have 4 bets. 98% of their assets is 1 bet. And they don't have sleepless nights. You know, they're pretty comfortable with single bet and a lot of the eggs in one basket. But if you know what you're doing, then it seems like insanity to own 30 stocks or even 20 stocks. The idea that you would actually understand 27 businesses as well as each of them or equally is unlikely. So there's circle of competence issues, there's a depth of understanding issues that come in. And so from my point of view, the answer has been, at least in Pabrai funds, has been to go with like a 10 by 10 portfolio, 10 stocks, 10% each seems like a good medium.
Mohnish mentions something very important: sleepless nights. We are all different and we all can cope well with different levels of stress. And we should not forget about that when building our portfolios. And just like Bill Ackman, he talks about owning 10 stocks. But he's a little more specific. He believes that a good starting point is 10 stocks and every one of them is equal to around 10% of the portfolio. Let's now listen to Peter Lynch, because he takes this idea of 10 by 10 portfolio one step further.
So I don't believe in diversification at all. I would own 1 stock. But what I do believe in is if I find 10 good stories, they're all equally attractive, I buy all 10. And I wait to see them unfold. It's like watching 10 poker games. 10 games of stud poker. You watch the cards turn over, story 3 gets better, story 6 slips, story 7 stays the same but it goes up 50%, so you sell 7 and buy 2. That's all I do. So if they're equally attractive, I buy all 10. Then gradually some story says, oh my God, this is getting better and better, and guess what? The stock just went down. So you keep watching 10 stories and magically, because of that rule of stocks going up and down a lot, then you load up. You really, take a big advantage.
The idea of treating stocks like stories, which we observe and then make changes to them, sounds really interesting and clever. So which way should we go? Should we follow Ray Dalio and diversify, or should we just buy index funds, or maybe have a portfolio of 10 stocks? It really depends on our personality. In Psychology of Money, and I made a video about this book, so you can find the link in the description, we can read that whatever strategy makes you sleep well at night is the best strategy. If you can't sleep because you feel you are missing out on some opportunities, then be more aggressive. If you can't sleep because you worry that you will lose your money, be more cautious. I personally like the idea of owning around 10 stocks, maybe with some dividends, which I treat as a kind of an insurance or a bonus. I do not think I would be able to own more than 15 stocks, because you do have to follow them just to check if the story is not changing. And like Peter Lynch told us, if we see that it is changing, then we can decide what to do. So, thank you for watching. I hope you found this video helpful and interesting, and if so, then please like it and subscribe to the channel if you want to see more videos like this one. Thanks again, and see you in the next one. Bye bye.